Welcome to WealthWise by Bright Dawn, your go-to source for mastering money, building wealth, and achieving financial freedom. From remote work to passive income, we share practical tips to help you take control of your finances. Subscribe and start your journey today. Hello everyone, let's talk about investing. Investing is a powerful tool that can help you achieve your financial goals, whether it's buying a home, funding your children's education, or securing a comfortable retirement. It's a way to make your money work for you, rather than just sitting in a savings account earning minimal interest. It's a way to grow your money over time. Just like a plant needs water and sunlight to grow, your investments need time and the right conditions to flourish. The earlier you start, the more time your money has to grow. Investing can be a little scary at first. The financial markets can seem complex and intimidating, and the fear of losing money can be overwhelming. But remember, every successful investor started where you are now, feeling uncertain and a bit anxious. But don't worry, we're going to learn together. With the right knowledge and guidance, you can become a confident and successful investor. It's important to seek out resources, ask questions, and learn from those who have experience. The most important thing is to start learning. There are countless books, online courses, and seminars available to help you understand the basics of investing. The more you learn, the more confident you'll become in making investment decisions. Knowledge is power, especially with your money. Understanding how different investment vehicles work, such as stocks, bonds, and mutual funds, will help you make informed decisions that align with your financial goals. Investing in the stock market can help you build wealth. Over the long term, the stock market has historically provided higher returns compared to other types of investments. However, it's important to remember that with higher potential returns comes higher risk. It's like planting a seed that grows into a big tree. You start with a small amount of money, and over time, with regular contributions and the power of compounding, your investment can grow significantly. But you need to water it and give it time. Just like a plant needs regular care, your investments need regular monitoring and adjustments to ensure they stay on track to meet your goals. It's the same with your money. Regularly contributing to your investment accounts, even small amounts, can make a big difference over time. Consistency is key. You invest it, and it has the potential to grow over the years. The power of compounding means that your returns start generating their own returns, leading to exponential growth over time. Before you start, it's crucial to learn about investing. Understanding the basics, such as risk tolerance, asset allocation, and diversification, will help you create a solid investment plan. It's like learning to drive before getting behind the wheel. You wouldn't start driving without knowing the rules of the road, and the same goes for investing. You need to understand the principles and strategies before you start. You need to know the rules of the road. In investing, this means understanding market trends, economic indicators, and how different events can impact your investments. In investing, you need to understand the basics before you start putting your money in. This includes knowing your financial goals, your risk tolerance, and the time horizon for your investments. Remember, investing is a journey. It's not something that happens overnight. It requires patience, discipline, and a long-term perspective. It's not a get-rich-quick scheme. Avoid the temptation of high-risk investments that promise quick returns. Instead, focus on building a diversified portfolio that can weather market fluctuations. It's about making your money work for you over the long term. By investing wisely and staying committed to your plan, you can achieve your financial goals and enjoy the benefits of financial security. So, are you ready to begin? Let's dive in. Together, we'll explore the world of investing and take the first steps towards building a brighter financial future. Now let's stop for a minute. Did you know 80% of viewers haven't subscribed yet? If you're enjoying this, hit subscribe, like, and share. It really helps the channel grow. Disclaimer: the content on WealthWise by Bright Dawn is for educational purposes only and not professional financial, legal, or tax advice. Always consult a certified advisor before making financial decisions. We're not responsible for actions taken based on this content. Imagine a giant online marketplace. This marketplace is not for everyday items like clothes or groceries, but for pieces of companies. These pieces are called stocks, and they represent ownership in a company. This is the stock market. It's a place where companies and investors come together to buy and sell these pieces of ownership. Companies sell small pieces of themselves, called stocks, to raise money for various purposes, such as expanding their business, developing new products, or paying off debt. When you buy stock, you become a part owner of that company. This means you have a claim on part of the company's assets and earnings. The stock market is where buyers and sellers come together. It's a dynamic environment where prices are constantly changing based on supply and demand. They trade stocks throughout the day, reacting to news, economic data, and other factors that influence stock prices. The prices of stocks go up and down. This fluctuation is driven by the basic economic principle of supply and demand. This is based on supply and demand. If more people want to buy a stock, the price goes up. Conversely, if more people want to sell it, the price goes down. If more people want to buy a stock, the price goes up. This can happen for various reasons, such as positive news about the company, strong earnings reports, or general optimism about the economy. If more people want to sell it, the price goes down. This can be due to negative news, poor earnings, or broader economic concerns. Think of it like a popular toy. If everyone wants it, the price will be high because the demand is greater than the supply. If everyone wants it, the price will be high. This is similar to how stock prices rise when there is high demand. But if nobody wants it, the price will drop. Just like a toy that isn't popular, stocks can lose value if there is more supply than demand. The stock market can be unpredictable. Prices can change rapidly due to various factors, including economic data, political events, and market sentiment. But over the long term, it has generally trended upwards. Historically, the stock market has provided strong returns for investors who are patient and invest for the long haul. Remember, investing in the stock market involves risk. It's important to do your research and understand what you're investing in. The value of your investments can go down as well as up. Market volatility means that prices can fluctuate, sometimes dramatically. But with careful planning and a long-term approach, it can be a rewarding way to grow your wealth. Diversifying your investments and staying informed can help manage risks and maximize potential returns. Not all stocks are the same. Just like the world of automobiles, the stock market offers a variety of options, each with its own unique features and benefits. Understanding these differences is crucial for making informed investment decisions. There are different types, just like there are different types of cars. Some stocks are designed for growth, while others focus on providing steady income. Just as you wouldn't compare a sports car to a family sedan, you shouldn't compare growth stocks to income stocks without understanding their distinct purposes. Two common types are common stock and preferred stock. Let's understand the difference. Common stock is the most prevalent type of stock that people invest in. It represents ownership in a company and entitles the shareholder to a portion of the company's profits. Common stock is like the standard model. It's the go-to choice for many investors because it offers the potential for capital appreciation. This means that if the company performs well, the value of your shares can increase over time. When you buy common stock, you get a vote in company decisions. This voting right allows you to have a say in important matters such as electing the board of directors or approving major corporate policies. It's like having a voice in the direction the company takes. You also have the potential to earn dividends. Dividends are payments made by a company to its shareholders, usually from profits. They can provide a steady stream of income, which can be particularly appealing for long-term investors. Dividends are like bonuses that companies give to their shareholders. They are typically paid out quarterly and can be reinvested to purchase more shares, further compounding your investment over time. Preferred stock is like the luxury model. It offers certain advantages over common stock, such as fixed dividend payments and priority over common stock in the event of a company's liquidation. It usually doesn't come with voting rights. This means that as a preferred shareholder, you won't have a say in the company's management decisions. However, the trade-off is often worth it for the stability and predictability of the dividends. But it offers a fixed dividend payment. This can be particularly attractive for investors looking for a reliable income stream, similar to how a luxury car offers a smooth and comfortable ride. This means you get a regular payment, like receiving a paycheck. These fixed payments can provide financial stability, making preferred stock a popular choice for conservative investors. Each type of stock has its own advantages. Common stock offers growth potential and voting rights, while preferred stock provides fixed dividends and priority in asset distribution. It's important to understand the difference before you invest. Knowing the characteristics of each type of stock can help you make better investment choices that align with your financial goals. You want to choose the type of stock that aligns with your financial goals. Whether you're looking for growth, income, or a balance of both, understanding your options is key. Remember, investing is like choosing the right car for your needs. Just as you would test drive a car before buying, you should thoroughly research and understand a stock before investing. You need to consider your budget, your lifestyle, and your preferences. By doing so, you can make informed decisions that will help you achieve your financial objectives and build a secure future. Section 4. Risk and return. Two sides of the same coin. Risk and return are like two sides of a coin. They always go together. When you invest, you're taking a risk. The value of your investments can go down, but you're also hoping for a return. This means you want your investments to grow in value. Generally, higher risk means potentially higher returns. For example, investing in a new startup company is risky, but if the company succeeds, you could make a lot of money. On the other hand, lower risk means potentially lower returns. Investing in a well-established company is generally less risky, but you might not earn as much money. It's important to find a balance between risk and return. You want to invest in a way that aligns with your comfort level. If you're not comfortable with a lot of risk, you should choose more conservative investments. Section 5. Dollar cost averaging investing made easy. Investing in the stock market doesn't have to be complicated. One simple strategy is called dollar cost averaging. It's like putting small amounts of money into a savings account regularly. With dollar cost averaging, you invest a fixed amount of money at regular intervals. You do this regardless of the market conditions. For example, you might invest $100 every week, whether the market is up or down. This strategy helps to reduce the impact of market volatility. When the market is down, you're buying stocks at a lower price. When the market is up, you're buying stocks at a higher price. Dollar cost averaging is a great way to invest for beginners. It's a disciplined approach that takes the emotion out of investing. It's like putting your investments on autopilot. Thank you for watching. Don't forget to subscribe and like this video for more investing tips.